325 million people paid Netflix this quarter. That is larger than the entire population of the United States, and the stock fell 10% the next morning.
That is the Netflix paradox in one sentence. Beat on revenue, beat on earnings, lose a tenth of your market cap because guidance was a few $100 million short of what analysts hoped.
I'm Hudson Thomas. Welcome to Charged Alpha, the S&P 500 stock encyclopedia. Today we are going deep on NFLX, Netflix Inc., fresh off Q1 2026 earnings reported April 16th. And there is no shortage of things to talk about.
There is a massive one-time earnings item baked into the headline number, a co-founder stepping away from the board, a new advertising business that is starting to look like a real business, and a stock that just handed investors a 10% markdown in a single session.
Let's unpack every piece of it. Lana, take us through the company first. So let's set the stage. Netflix was incorporated in 1997 in Los Gatos, California. Originally a DVD by mail service, it is now the world's most recognized streaming brand, operating in more than 190 countries with 325 million paid subscribers as of its last disclosed figure in January.
The business model is subscription-based streaming. Members pay monthly, either on an ad-supported standard tier, a standard tier without ads, or a premium tier with higher quality and more simultaneous streams. The pricing varies significantly by country, but the global average revenue per member has been climbing as the company pushes premium tiers and the ad tier gains scale.
And then there is the advertising layer on top of that. Netflix launched its ad-supported tier in 2022, and the growth has been remarkable. They now have more than 4,000 advertisers. The advertiser count grew 70% year over year, and they are guiding for $3 billion in advertising revenue in 2026. That would be a full doubling from 2025.
The content slate is what makes the machine run. Netflix spent approximately $17 billion on content in 2025, a spend level that no new entrant can match. They have produced global hits across languages and genres. Squid Game out of South Korea Wednesday, Bridgerton, Stranger Things in the US, La Casa de Papel from Spain. This is a genuinely global content engine.
What is the competitive moat here? Because content spending sounds like an arms race.
It is partly an arms race, but Netflix has turned its scale into a structural advantage. 325 million subscribers generates behavioral data that its recommendation algorithm uses to reduce churn and surface the right content to the right viewer. High switching costs. People have curated preferences and watch lists, plus the sheer volume of the library make it difficult to cancel. And the brand is synonymous with streaming in a way Disney and Amazon simply have not replicated globally.
Worth noting, they stopped reporting quarterly subscriber counts after Q4 2025. Management says they want investors focused on revenue and operating income rather than a vanity metric. Analysts in the market have mixed feelings about that choice.
It is a double-edged sword. On one hand, it shifts focus to financial fundamentals, which are excellent. On the other, it removes transparency at a moment when investors are asking whether subscriber growth has a ceiling.
Let's talk leadership. Netflix has two co-CEOs, Ted Sarandos and Greg Peters. But before we get to the co-CEOs, the headline this quarter came from the person above them on the org chart.
Reed Hastings, co-founder of Netflix, former CEO, and until this week, executive chairman. He announced alongside Q1 2026 results that he will exit the board of directors in June when his term expires in order to focus on philanthropy.
Hastings co-founded the company in 1997 with Mark Randolph. He ran it as CEO for decades, built it from a DVD by mail curiosity into a $400 billion market cap streaming giant, and transitioned to co-CEO in 2020 before becoming executive chairman in 2023. This is the end of an era.
Ted Sarandos responded by saying, "Reed has been a singular source of inspiration for me, personally and professionally, since we met in 1999. That is not corporate speak. Sarandos has worked alongside Hastings for over 2 decades and built the content business that made Netflix what it is."
So who is running the company now? Ted Sarandos is co-CEO focused on content. He joined Netflix in 2000 and engineered the original content bet that produced House of Cards, Orange is the New Black, and ultimately Squid Game. He understands story, talent and creative risk.
Greg Peters runs the other half: technology, product, and increasingly advertising. He served as Chief Operating Officer and Chief Product Officer before becoming co-CEO in 2023. The $3 billion advertising target for 2026 is his initiative. The dual CEO structure has operated without visible friction since 2023, and the board's nominating committee has already signaled it will restructure governance following Hastings' departure.
The institutional read on Sarandos and Peters is broadly positive. Two operators who know the business deeply, with complementary skill sets, at a company that has strong enough momentum to manage a leadership transition without missing a beat. Let's dig into the financials. Lana, take us through Q1 2026.
Starting with the headline. Netflix reported Q1 2026 revenue of $12.25 billion, up 16.2% year-over-year versus Q1 2025's $10.54 billion. That beat the consensus estimate of $12.18 billion. Revenue has now crossed $12 billion in back-to-back quarters.
16% growth on a $12 billion quarterly base. That is not easy to sustain.
It is not, and here is where I need to slow down for a moment on the EPS line. Netflix reported diluted earnings per share of $1.23 in Q1 2026 versus the Street's estimate of 79 cents. That looks like a massive beat. It was, but not entirely for operating reasons.
The BD payment.
Correct. Netflix received a $2.8 billion one-time termination payment from Paramount Skydance related to the cancellation of a content partnership agreement with Warner Bros. Discovery. That payment flows through the other income line and inflated net income to $5.28 billion in the quarter. Strip it out and operating earnings look much more modest.
So the operating picture is still strong, but the headline EPS number is not apples to apples.
Right? Looking at what the business actually earned from operations, operating income was $3.96 billion on $12.25 billion of revenue. That is a 32.3% operating margin, which is genuinely excellent. Q1 2025 operating margin was 31.7%, so they expanded margins year over year while growing revenue at 16%. That is real operating leverage.
Let's do the valuation.
The stock closed April 17th around $97, giving Netflix a market cap of approximately $412 billion. On a trailing 12-month basis, using the last 4 quarters of revenue, which totals roughly $46.9 billion, the price-to-sales multiple is about 8.8 times. The trailing PE ratio is 30.7 times. Price-to-book is 13.2 times because Netflix has bought back enormous amounts of stock.
The cash flow picture is genuinely impressive.
Exceptional in Q1, with a caveat. Operating cash flow in Q1 2026 was $5.29 billion, and free cash flow was $5.9 billion. Both of those numbers are elevated because the $2.8 billion WBD payment is classified as operating cash flow. Adjust for that, and you still get approximately $2.3 billion in organic free cash flow for the quarter, which annualizes to around $9 billion. That is a serious cash generation machine.
The balance sheet.
Netflix holds $12.26 billion in cash against $14.36 billion in total debt, giving a net debt position of just $2.1 billion. For a company generating $9 to $12 billion in organic free cash flow annually, that is a trivially small leverage position. Total assets of $61 billion with equity of $31 billion. They also bought back $1.27 billion in stock during the quarter. Overall, Netflix's financial health is strong. The company expanded operating margins year over year, generates billions in free cash flow, holds minimal net leverage, and is monetizing its 325 million subscriber base through a growing advertising layer that is just now hitting meaningful scale.
What does Wall Street make of all this?
The consensus is strong buy. Out of roughly 40 analysts covering Netflix, approximately 28 are at buy or outperform, 10 are at hold or neutral, and only 2 are negative. The average price target heading into this episode is around $115.80, implying about 19% upside from where the stock is trading post-earnings.
That is interesting. The stock dropped 10%, and the average target is still almost 20% above current price.
Which tells you most analysts view the sell-off as an overreaction to the Q2 guidance miss rather than a fundamental deterioration. KeyBank raised its target from $108 to $150 and maintained overweight, noting that the resolution of the Warner Bros. Discovery situation leaves Netflix with a cleaner strategic story. Wedbush raised its target to $118, highlighting the advertising monetization as underpriced by the market.
Goldman Sachs upgraded NFLX from neutral to buy on April 6 before earnings, citing the advertising runway, and JP Morgan moved to overweight from neutral in March.
The contrarian view comes from Barclays at equal weight and Rosenblatt at neutral. Both are cautious about subscriber count opacity now that Netflix has stopped reporting quarterly member figures, and they flag the Q2 guidance as evidence that growth is becoming harder to sustain. Q1 revenue came in at $12.25 billion against $12.18 billion estimated. EPS was $1.23 versus $0.79 expected. But the Q2 guide of $12.57 billion revenue landed below consensus, and that is what sent the stock lower.
Let me lay out the bull case. Netflix is building a second revenue engine inside a business that already has 325 million paid subscribers. Advertising revenue is targeting $3 billion in 2026, doubling year over year, with 4,000 advertisers and 70% advertiser growth. That is a new earnings stream that did not exist 5 years ago, and it compounds as the ad-supported tier reaches critical mass. Add international expansion in Asia-Pacific and Latin America, a live event strategy that demonstrated real sports and event viewership, and buybacks of over $1 billion per quarter. And this stock looks compelling at current levels for a business of this quality.
The bear case is structurally different. Subscriber growth appears to be plateauing near 325 million. The decision to stop reporting subscriber counts makes that harder to verify, which is itself a concern. The Q2 guidance miss suggests the deceleration is real. The advertising business, while growing, is competing for brand budgets against Google and Meta, who have vastly more targeting data and advertiser relationships. And at 8.8 times trailing sales and 30 times trailing earnings, the multiple demands near-perfect execution. One bad quarter, a content flop, an ad market slowdown, a macro shock, and that premium can evaporate quickly.
And the Reed Hastings departure adds a governance transition risk at a complicated moment.
It does. Hastings is not involved in day-to-day operations, but he is the cultural touchstone. When the founder leaves, the board changes character. That is not a crisis. It is just a new unknown for investors to price.
Let's stack Netflix against some peers. Disney is the most direct streaming competitor. It is trading at around 1.85 times trailing sales, with Disney Plus at roughly 124 million subscribers versus Netflix's 325. Disney's overall revenue growth is around 4%, compared to Netflix's 16%.
Disney is a more diversified business with parks and studios, but the streaming segment is subscale versus Netflix and has barely turned profitable. Netflix is almost 5 times Disney's price-to-sales multiple, but growing revenue at 4 times the rate and generating dramatically more streaming cash flow.
Spotify is an interesting analog, subscription streaming in audio rather than video. Spotify is growing revenue at about 20% year over year and trades at 4.8 times sales, but it has a much weaker margin profile than Netflix, which is generating real operating leverage at 32% operating margins.
Warner Bros. Discovery is the most sobering comparison and the most recent Netflix headline. WBD trades at just 2.55 times sales with declining revenue and paid Netflix a $2.8 billion termination fee this quarter. That one payment alone was a meaningful fraction of WBD's total market capitalization at various points this year.
Options market. What were traders pricing in?
Going into Q1 2026 earnings, the options market was implying about a 7.13% move in either direction. The put-call ratio was around 0.71, modestly bullish. Implied volatility was at the 68th percentile. The market expected a meaningful move, but was leaning constructively going into the print.
And then Netflix moved almost 10% to the downside, exceeding the implied move. Put holders were rewarded. Pre-earnings open interest was clustered at $105 to $120 calls and $90 to $85 put protection. Post-earnings, those downside strikes are now relevant as short-term floor levels. As always, options markets reflect probabilities, not predictions. What are insiders doing?
The noteworthy activity in early April was mostly planned option exercises. Reed Hastings exercised 420,550 stock options at a $9.44 exercise price and sold all of those shares in open market transactions around $95 to $97 per share on April 1st. That is a pre-scheduled liquidation tied to option expiration, not a bearish signal.
CFO Spencer Newman also exercised and sold 28,630 shares at $98 on April 2nd. Director Jay Hogue received a new option grant. No unusual C-suite open market buying, but also nothing to suggest insiders are fleeing. These are textbook grant monetization transactions, not opportunistic selling. What are the main risks and watch points going forward?
5 things. First, the Q2 2026 print. Netflix guided $12.57 billion in revenue and a 32.6% operating margin. Landing at or above those numbers validates the bull case. Missing them validates the bears.
Second is the advertising revenue trajectory.
The $3 billion full-year target requires meaningful acceleration in the second half. Watch for any Q2 commentary on ad bookings, CPM rates, and active monthly ad tier subscriber trends.
Third is subscriber count commentary.
Even informal commentary at investor events about global paid membership will move the stock. The market does not fully trust a metric removal story when the metric removed is the one everyone cares about most.
Fourth is board governance post-Hastings. And fifth is content slate execution. Whether Squid Game Season 3, Wednesday, and the 2026 film slate produce hits that sustain subscriber retention and advertiser confidence. All right, let's bring it all together. What is the bottom line on Netflix?
Netflix is a category-defining business with genuine competitive advantages: subscriber scale, content quality, and a data flywheel that reinforces both. The financial profile is exceptional: 32.3% operating margins in Q1 2026, over $5 billion in quarterly free cash flow including the one-time item, and net debt of just $2.11 billion.
The near-term overhang is the Q2 guidance miss, the decision to stop reporting subscriber counts, and the departure of Reed Hastings from the board. Real uncertainties.
But 28 of 40 analysts are bullish with an average target near $115, about 19% above where the stock sits today. The key metric to watch is simple. Does Netflix land at or above its $12.57 billion Q2 revenue guide? And does the advertising business approach its quarterly run rate toward that $3 billion full-year target? Those 2 data points will determine whether this dip gets bought or deepens.
We will leave you with a quote from management consultant and author Peter Drucker. The most important thing in communication is hearing what isn't said.
That applies directly to Netflix this quarter. What the company chose not to say, no subscriber count, no breakdown of ad revenue, is what the market reacted to most. Whether that silence reflects confidence or caution is the question every investor is sitting with right now.
That is going to do it for today's episode of Charged Alpha on Netflix, ticker NFLX, Q1 2026 earnings deep dive. And hey, if you want to run the same research workflow we use to build these episodes, everything's free at chargedalpha.com. 11 screening tools across stocks, ETFs, options, crypto, bonds, REITs, commodities. No sign-up, no paywall. The same data that powers this show is sitting there waiting for you to run your own screens. Check it out. Until then, I'm Hudson Thomas.
This podcast is for informational and educational purposes only. Nothing discussed today constitutes a buy, sell, or hold recommendation for any security mentioned. All investments carry risk, including the risk of total loss of principal. Past performance does not guarantee future results. Always do your own research and consult with a qualified financial advisor before making any investment decisions. The hosts and producers of Charged Alpha may hold positions in securities discussed on this show. This episode was researched, written, and produced using AI-assisted tools. All data has been aggregated from publicly available sources and may contain inaccuracies. Data is current as of the recording date and may have changed.
Ooh-wee-doo! That ticker tape starts dancing fast. A bull market thrill that's built to last. Dividends are ringing up the swing. Listen to that sweet ka-ching. It's a Wall Street swing. That fast-paced rhythm makes you sing. Yeah, the Wall Street swing.